Welcome back to the Deep Dive. We're the place you come to make sense of complex sources, from dense regulatory papers to, well, fiery geopolitical statements.
And today, we've got quite a mix.
We really do. We're digging into a piece of legislation that honestly sounds pretty dry on the surface, the Genius Act.
Right. S. 4. Sounds like standard Washington stuff.
Exactly. But our sources, they're telling a very different story. They say this act is fundamentally shaking up global finance.
It really is. It's a fascinating example of strategic policy, I think.
Yeah.
What Congress passed back in July 2025, the Guiding and Establishing National Innovation for United States Stablecoins Act. It's framed as a federal framework for payment stablecoins.
Yeah.
You're making things safe.
But the global reaction tells you it's much, much bigger than just crypto rules.
Absolutely.
So that's our mission today. We're going beyond the legalese, straight into the global implications. Because while the U.S. is talking up consumer protection, innovation.
Usual talking points.
Yep. Critics, especially places like Russia, are framing this as the next evolution of U.S. monetary hegemony. And they've made this truly staggering accusation.
Yeah, the idea that the U.S. is using this law to, and I quote, offload its $37 trillion national debt onto the global economy.
It's a massive claim.
It is, and we have to tackle it carefully, impartially. Look at the data, look at the political spin on both sides.
So for this deep dive, we're going to examine this through four crucial lenses. First, the economics, this new idea of digital debt management.
And the geopolitics.
Yeah.
The strategy behind it all.
Third, the big fight that happened before the law passed Wall Street versus Silicon Valley, a real regulatory battle.
And finally, the bigger picture. What does this mean for the market for innovation long term? We really need to understand the sort of plumbing of how digital money is going to work globally now.
Okay, let's start right there with the law itself. The Genius Act. Why now? What problems, according to the sources, was it urgently trying to fix?
Well, there were really two main drivers. Integration and stability. The crypto world had gotten big, but the 2022 Terra USD collapse.
Yeah.
That was a wake-up call.
Right, the algorithmic stablecoin that just imploded.
Exactly. It wasn't backed one-to-one by real assets, just code. And when it crashed, it wiped out something like $40 billion, almost overnight.
Ouch.
Yeah. So regulators in the U.S. realized, okay, we've got these dollar-pegged assets heading towards $500 billion globally, maybe more. We can't just let them operate in the Wild West anymore. The risk was too big.
The risk of contagion into the traditional financial system?
Precisely. So the goal became bring this high-growth but also high-risk sector into the regulated fold. Make sure a crypto blow-up doesn't take down something bigger.
So what does that integration actually look like? What are the core rules for these stablecoin companies now?
There are 5 really strict requirements that basically reshape the industry. First, and this is the tier one, 100% reserves.
Meaning for every digital dollar they issue, they have to hold a real dollar's worth of backing.
Exactly. And not just any backing. It has to be super safe stuff. Actual cash, cash equivalents, or, and this is key, short-term U.S. Treasury bills, T-bills.
Okay, so no more risky algorithms, no iffy commercial paper, just pure verifiable backing, mainly by government debt.
That's the idea. Second rule, transparency. They had to get regular third-party audits of those reserves, and they have to publish the results, make it public.
So everyone can see they actually have the backing.
Right. Third, they have to comply fully with AML/BSA. That's Anti-Money Laundering and the Bank Secrecy Act.
The same rules traditional banks follow.
Essentially, yes. Strict tracking of transactions, know your customer KYC requirements. So verifying identities. This pulls stablecoins firmly away from the idea of anonymous crypto transactions.
Makes sense. And points 4 and 5 are about licensing and who's in charge, right? The federal government's stepping in.
Yeah. Issuers now need a single federal license. This overrides that messy patchwork of different state rules they had before. Makes it much easier to operate nationwide.
Streamlines things for the industry.
Definitely. And a fifth point gives the U.S. global reach. If a foreign stablecoin company wants to operate in the U.S. system, or even just serve U.S. customers, they need to partner with a U.S.-registered firm that meets these same high standards.
So basically, the U.S. rules become the global standard for any serious digital dollar project.
That's the effect, yeah. It sets the bar.
Okay, this is where it gets really interesting, moving from just regulation to, well, national strategy. This pro-U.S. view, what our sources are calling the digital debt engine. Supporters don't just see risk management, they see something ingenious. Fiscal pragmatism.
You could argue it's one of the cleverest bits of quiet fiscal policy we've seen in a long time. The genius, if you want to call it that, is how it fuses crypto innovation with America's biggest headache, managing its massive national debt.
How does it do that? The mechanism seems simple but powerful.
It is simple. Mandating 100% backing in treasuries means every time someone, somewhere in the world, buys or holds a regulated stablecoin, that demand automatically translates into a purchase of U.S. government debt.
And the scale here isn't trivial. Even before this act really kicked in, the big players like Tether, USDT, and Circle, USDC, they were already huge holders of T-bills.
Huge. Collectively, they held over $120 billion in short-term treasuries. Think about that.
Wow.
That $120 billion, to put it in perspective, that makes these private crypto companies comparable to, say, the sovereign wealth fund of Saudi Arabia or South Korea in terms of how much U.S. debt they hold.
But with a key difference.
Right. A sovereign wealth fund chooses to buy treasuries for strategic reasons.
Yeah.
These stablecoin issuers have to buy them just to operate, to keep their dollar peg stable. It's built into their business model now by law.
And the real ambition here is the future growth, right? The projections.
Exactly. Analysts are looking at the adoption curve for stablecoins and saying, look, if this continues, if the market surpasses, say, $2 trillion by 2030,
which seems plausible given the trends,
then this mechanism could automatically generate trillions of dollars in new passive demand for U.S. treasuries.
Passive demand meaning money flows into U.S. debt without the government needing to raise taxes, or the Fed having to print money through QE.
Precisely. It's like the private crypto sector globally is volunteering to become this dedicated debt financing arm of the U.S. Treasury. It helps keep U.S. borrowing costs lower than they might otherwise be.
Which is a massive economic plus with a $37 trillion debt hanging over you.
Yeah.
Okay, but there's always another side. Let's flip to the critical view, the de-dollarization camp. They see this as a hidden debt dump.
Yes, and they're explicitly comparing it to the 1971 Nixon shock.
When Nixon took the U.S. off the gold standard.
Right. The argument then was the U.S. forced the world onto unbacked paper dollars. The critics now say the Genius Act just does the same thing for the digital age. It forces the world, if it wants stable digital dollars, to hold U.S. debt.
And we have that quote from the Russian official Anton Kobyakov.
Yeah, he was very blunt. Said the act lets the U.S. export inflation and globalize its debt.
Okay, explain that logic. How does forcing stablecoin reserves into treasuries export inflation to someone in, say, Brazil holding USDC?
The argument revolves around who bears the ultimate risk. So the person in Brazil holds USDC because it's pegged to the dollar, seen as safe, backed by treasuries, the world's safest asset, right?
Okay.
But what if the U.S. government, facing its huge debt load, decides down the line to pursue inflationary policies, basically printing more dollars to manage its liabilities?
Which devalues the dollar's purchasing power.
Exactly. So the holder of the dollar-pegged stablecoin, whether they're in Brazil or Botswana, sees the value of their holdings erode. The critics argue this is a way for the U.S. to effectively restructure its debt through inflation without actually defaulting. Washington gets the financing benefit up front, and the global user pays the price later through lost purchasing power. A digital inflation tax, essentially.
But hang on. If people are choosing to hold these stablecoins because treasuries are the safest asset, isn't calling it a Ponzi scheme a bit much? That seems like pure political rhetoric from Moscow.
Oh, Ponzi is definitely political hyperbole. It's meant to delegitimize the whole system. A real Ponzi scheme uses new investor money to pay off old investors. It's fraud. This isn't that.
Right.
But the structural concern they're raising isn't entirely baseless. It's about the growing reliance on this private mechanism to fund public debt. If stablecoin reserves balloon to, say, $5 or $10 trillion, as some projections suggest.
That's a huge number.
It is. And if that amount represents 10% or even 20% of the U.S.'s ongoing debt rollovers, then the U.S. financial system becomes structurally dependent on continued global demand for these specific digital dollar products.
So the vulnerability isn't fraud, it's dependence. What happens if that demand suddenly dries up? Or if there's a crisis of confidence and everyone tries to cash out their stablecoins at once?
That's the systemic risk concern. A massive sell-off of stablecoins would mean a massive sell-off of the underlying treasuries. That could destabilize the U.S. debt market, spike borrowing costs, and potentially force the Federal Reserve to step in and buy up that debt, which is inflationary money printing. So, while not a Ponzi, it creates this deep global interdependence where the stability of digital finance rests heavily on continuous demand for U.S. debt.
Okay, that clarifies the risk argument. Let's shift gears to the geopolitical chessboard now. Because the Genius Act isn't just about economics, it's clearly a strategic play by Washington. a countermove against challenges to the dollar.
Absolutely. The U.S. isn't just watching passively while things like China's digital yuan, the ECNY, that's their official central bank digital currency, or CBDC, get rolled out, or while Russia tries to build alternative payment networks, maybe linked to gold.
They're fighting back.
They are. But instead of relying solely on a slow, government-built CBDC, they're using the Genius Act to harness the private sector. By setting high standards for stability and safety for these private USD-pegged stablecoins, the U.S. is essentially leveraging Silicon Valley's speed and innovation to lock in the dollar's advantage.
And the market reality helps them immensely. That over 90% of global stablecoins were already pegged to the US dollar even before this act.
Right. The act doesn't create that dominance, it formalizes and secures it. But making regulated, audited, treasury-backed stablecoins the premium offering, the U.S. makes them far more attractive to big global institutions compared to some unregulated alternative or even a rival CBDC like the ECNY.
So it's dollar hegemony 2.0, using private tech for centralized monetary control.
You could definitely frame it that way. It reinforces the dollar's role using new tools.
And there's a huge national security dimension here too, isn't there? This isn't just about money, it's about power projection.
That's arguably the core strategic win for Washington, because the act mandates those strict AML/BSA rules we talked about.
Know your customer transaction monitoring.
Exactly. It makes transactions on these regulated stablecoin networks far more transparent and traceable than physical cash or even older, unregulated cryptocurrencies. This gives the U.S. Treasury powerful new capabilities.
Capabilities
Like monitoring for sanctions compliance, tracking illicit finance flows, and, crucially, the ability to freeze assets linked to designated entities or nations, think Russia, Iran, North Korea. The regulated digital dollar effectively becomes a highly sophisticated tool of economic statecraft, potentially the most powerful financial surveillance tool ever created.
Okay, if that's the U.S. strategy, then the counter-narrative from the BRICS countries calling it monetary colonization and kind of starts to make a lot more sense. They see it as the U.S. just upgrading its financial dominance toolkit.
That's precisely their perspective. They see it as a digital echo of the petrodollar system, which they argue forced countries to hold dollars to buy oil. Kobikov's quote again. Washington is weaponizing blockchain to preserve empire.
So from their view, the world is being pushed to fund U.S. deficits by holding Treasury-backed stablecoins,
while simultaneously becoming subject to U.S. financial surveillance and the risk of having their transactions frozen or seized if they fall foul of U.S. foreign policy. It's the combination of underwriting the debt and submitting to the jurisdiction that feels like colonization to them.
The analogy being, the petrodollar system recycled oil money into U.S. debt, and now this system recycles global crypto liquidity into U.S. debt. Same mechanism, new technology.
That's the critical parallel they draw. But the BRICS nations aren't just complaining. They're actively trying to build alternatives. Their de-dollarization strategy seems quite concrete.
Though they frame it as evolution, not revolution, they know they can't just ditch the dollar overnight.
Right. It's about gradual diversification, building resilience, reducing vulnerability to sanctions. The big lesson from Russia getting kicked off SWIFT in 2022.
So what are the main pillars of this strategy? The first seems to be boosting trade in their own local currencies. How significant is that shift?
It's becoming quite significant. The data shows that by mid-2025, over 30% of trade within the BRICS bloc was settling in local currencies. That's up sharply from maybe 10% or 15% just back in 2021.
Can you give some examples?
Sure. Big ones include Russia-India trade, especially in oil and coal, increasingly settling in rupees or rubles, and China-Brazil commodity deals, moving towards pricing and settlement in the Chinese yuan. Each transaction done this way bypasses the need for U.S. dollars as an intermediary currency.
Reduces costs and U.S. oversight.
Exactly. Second pillar, building their own financial plumbing. Alternatives to the SWIFT messaging network, which is largely Western-controlled.
What does that look like?
It involves several initiatives, things like the BRICS Cross-Border Payments Initiative, BCPI, and BRICS Pay. More concretely, they're working on linking up their existing national systems like Russia's SPFS and China's CIPS. Think of these as SWIFT rivals.
So creating redundancy. If one system is blocked, they have others.
That's the goal. They've even, according to some sources, been exploring things like the XRP ledger as a potential neutral bridge network for fast, cheap, cross-border payments using decentralized tech. It's still exploratory, but it shows they're looking at all options.
And the third pillar, the classic hedge, gold. The data on central bank buying is pretty staggering.
It really is. This signals deep, long-term distrust of the dollar-based system. We've seen the dollar's share of global central bank reserves fall significantly, from over 70% in the early 2000s down to around 54% by 2025.
And BRICS nations have been huge buyers of gold during that period.
Massive buyers. Yeah. Collectively, their central banks now hold over 6,000 tons of gold. And the pace is accelerating. They bought something like 200 tons just between 2022 and 2024.
Wow. And this gold buying often coincides with selling U.S. treasuries, right? Especially China.
That's the other side of the coin. China, for instance, has cut its holdings of U.S. treasuries by more than 25% since 2022. They're swapping U.S. IOUs for physical gold and other hard commodities.
Why gold specifically?
Because they see it as the ultimate neutral reserve asset. It's physical, it's universally valued, and crucially, it can't be easily sanctioned or seized by Washington or Brussels. They view these gold reserves as potentially underpinning future non-dollar trade settlement systems.
Okay, so you have local currency trade, alternative payment systems, massive gold buying. Sounds like serious momentum. Why is it still described as evolution, not revolution? What's holding back a faster break from the dollar?
There are some really fundamental challenges. First, the BRIC bloc itself has major internal divisions. The rivalry between India and China, for example, is deep-seated. India is very wary of anything that looks like Chinese dominance, which makes agreeing on a single BRICS currency or payment system extremely difficult right now.
Politics getting in the way.
Always. Second, there are huge practical hurdles. The U.S. dollar market is just so incredibly deep and liquid. Plus, many BRICS currencies aren't fully convertible or widely used globally. So despite the efforts, the dollar is still used in something like 88% of all global trade settlements. The infrastructure for a truly multipolar currency world just isn't there yet. It takes time to build.
Right, inertia is a powerful force in finance. Okay, let's pivot now and look inside the U.S. The Genius Act wasn't just handed down. There was a huge battle leading up to it between traditional finance Wall Street and the tech world Silicon Valley. Wall Street fought crypto hard for years. Why were they so afraid? What was the existential threat?
The fear was fundamental, rooted in what blockchain technology actually does. It enables disintermediation, cutting out the middleman, and banks are the traditional middlemen of finance.
So their core business model was under attack.
Directly. Think about payments, lending, stablecoins, and DeFi, decentralized finance, offer ways to do these things peer-to-peer, faster, cheaper, potentially bypassing banks entirely.
We have that quote from a JP Morgan executive, warning that stablecoins were a bigger long-term risk to our deposit base than any fintech ever was. That really captures the fear, doesn't it?
It absolutely does. Deposits are the cheapest source of funding for banks. It's how they make money, taking deposits and lending them out at higher rates. If stablecoins offered a compelling alternative for people and businesses to hold their cash digitally,
that money wouldn't be sitting in bank deposit accounts.
Exactly. That's the deposit flight fear, especially since stablecoins under this act hold their reserves in treasuries liabilities of the government, not deposits in the commercial banking system. Every dollar that moves into a stablecoin could be seen as a dollar leaving the banking system's funding base.
So potentially squeezing their ability to lend.
Potentially, yes. If stablecoins grew into the trillions, that could significantly impact bank liquidity and funding costs. This was a core reason they lobbied so hard against unregulated crypto.
And the third big fear, the loss of the payment monopoly. Visa, MasterCard, SWIFT. That whole infrastructure relies on fees.
It's a multi-trillion-dollar industry built on transaction fees, currency conversion fees, delays, essentially friction in the system. Blockchain promised 247 instant, near-zero cost global transfers. That directly threatened the revenue model of the entire payments industry.
So they fought it tooth and nail, framing it as risky and unstable.
For years, yes. The lobbying was intense, always focusing on the risks, the need for regulation that, ideally for them, would stifle the threat.
But in the end, the Genius Act passed. Crypto wasn't banned. So Wall Street didn't win outright, but they secured some key protections, right? It was more like assimilation than defeat.
That's a good way to put it. They managed the threat. They got crucial compromises baked into the law.
Like what?
Well, first, mandating reserves be held in treasuries helps channel liquidity towards the government, not a rival private banking system. Second, they got the full AML/KYC oversight, which plays to their strengths in compliance infrastructure. But the biggest win for the banks
was banning interest-bearing stablecoins.
Exactly. That was the red line. If stablecoins could legally pay interest, even a tiny amount, they would directly compete with bank savings accounts and money market funds. That could have triggered massive deposit flight.
So by banning interest, the act protects the core bank deposit franchise.
It preserves their cheap funding base, yes. So the banks accepted the payment innovation of stablecoins, but ensured it wouldn't fatally undermine their core lending business.
Okay, now let's flip to the other side. Silicon Valley, the tech and fintech companies, they seem almost thrilled with this regulation. They see it as a launch pad. Why celebrate rules?
For the tech world, the biggest obstacle wasn't necessarily the idea of regulation. It was the uncertainty, the regulatory risk or tail risk, the fear that regulators could suddenly crack down or change the rules arbitrarily. That kept a lot of big institutional money on the sidelines.
So the Genius Act, by providing a clear federal framework, removed that uncertainty.
Exactly. It provides regulatory clarity, a defined path to get licensed and operate legally nationwide. For Silicon Valley, regulation isn't a barrier, it's a scaffold. You need to build really big things, especially things that require trust and attract institutional capital.
So clarity unlocks investment. What do they envision building on this new regulated foundation?
They see stablecoins as the fundamental infrastructure layer for the next wave of financial innovation, like the operating system for digital value.
And what runs on that OS?
All sorts of applications. Cheaper global remittances, more efficient decentralized finance, DeFi protocols, and perhaps the biggest prize, the tokenization of real-world assets. Think real estate, private equity, art, turning illiquid assets into tradable digital tokens on a blockchain.
A potentially massive market.
Trillions and trillions. The Act legitimizes the stablecoin layer needed for all this. It makes it safer for big players, even traditional ones like JP Morgan with its JPM coin, or tech giants like PayPal with its PayPal USD to issue their own regulated tokens and build services on top.
And this plays right into the Silicon Valley playbook of network effects.
Absolutely. They're betting that the first few federally licensed large-scale stablecoins will become the dominant standards. The iOS or AWS of digital finance, as some put it.
The platform everyone else builds on.
Right. And once you have that standard, an entire ecosystem springs up around it. New wallets, new trading platforms, new financial products, all leveraging that trusted, regulated infrastructure. The market definitely saw it this way. Look at how Coinbase stock jumped when the act passed the Senate. That was a clear signal. The industry viewed this as a major catalyst, turning risk into a huge growth opportunity.
But they have to be aware of the trade-offs, right? Federal Reserve Governor Michael Barr warned about potential run risks, even with reserves. And this regulation clearly means more centralization and surveillance.
Oh, the awareness of risk is definitely there. The argument against run risk is the 100% reserve requirement in safe assets, very different from Terra USD's algorithmic model. But yes, they absolutely concede that federal licensing and strict AML KYC do mean more centralization compared to crypto's original ideals.
So less anonymity, more potential single points of failure.
Correct. That's the trade-off they've accepted. More centralization and surveillance in exchange for the regulatory certainty needed to attract mainstream institutional adoption. They're betting that the technology and governance structures they build will be robust enough to manage those inherent risks.
A calculated bet on scale.
Essentially, yes.
Okay, let's zoom out now. Beyond the immediate industry battles, what's the long-term vision here? Our sources talk about blockchain doing for value what the internet did for information, moving beyond just digitizing finance to creating genuinely new finance. What does that look like in practice?
It's about fundamentally changing how value moves. The internet made information flow instantly, globally, almost freely. Blockchain aims to do the same for value money, assets, ownership rights, erasing borders, cutting out intermediaries, making value transfer instantaneous and incredibly cheap.
We touched on the payment example earlier.
Right. That shift from a cross-border payment taking 3 days and costing maybe 8% in fees to it happening in 5 seconds for fractions of a penny. That's not just incremental improvement. It's a phase change. It radically lowers the cost of global economic interaction.
And this efficiency, ironically, could accelerate de-dollarization by making non-dollar transfers easier. But some sources argue this might actually be a good thing for the U.S. long-term. How does that work?
It goes back to that idea of the dollar's exorbitant privilege being a double-edged sword. Yes, it gave the U.S. immense power, but it also created economic distortions.
Like needing to run huge trade deficits.
Exactly. Yeah. To supply the world with enough dollars for global trade and reserves, the U.S. basically had to constantly buy more from the world than it sold, exporting dollars. Some economists argue this constant outflow contributed significantly to U.S. deindustrialization over decades, as the economy shifted towards finance and consumption, away from making things.
So the argument is, if new tech naturally reduces the world's need for so many dollars, it eases that pressure on the U.S. economy.
Precisely. The U.S. might trade some of its absolute currency monopoly for a stronger position based on technological leadership. If the U.S. sets the standards and hosts the most trusted infrastructure for digital finance via things like the Genius Act, it retains enormous influence, even if the dollar's share of global transactions decreases somewhat. It's a potential rebalancing, allowing the U.S. maybe to refocus on domestic production without crashing the global system that relies on dollar liquidity.
A shift from monetary power to platform power.
That's a good way to think of it.
Now, let's look at where the impact could be most profound. The Global South. Sources talk about unlocking potentially $50 trillion in untapped value. What is this hidden wealth?
This $50 trillion represents what economists sometimes call dead capital. Its assets primarily land, but also informal businesses, potential labor that exists but aren't formally recognized or integrated into the financial system. They can't easily be used as collateral, they can't be easily bought or sold across borders. For billions of people, poverty isn't just lack of income, it's lack of formal identity and lack of clear title to the assets they do possess.
And technology is the key to making this invisible wealth visible and usable.
That's the promise. Technologies like blockchain, combined with digital identity and mobile connectivity, offer a path to prosperity parity by bringing these assets onto formal, verifiable ledgers.
Let's break down how these technologies converge. Digital ID seems crucial.
Absolutely. Look at India's Aadhaar system providing unique, verifiable digital identity to over 1 billion people. That's the foundation. Then you layer on real-time payment systems like India's UPI, Unified Payments Interface, which allows instant, virtually free mobile payments.
So you have identity and payments sorted. Where does blockchain fit in?
Blockchain provides the trust layer, the immutable record keeping. You combine digital ID with seamless payments on a trusted ledger, and you can effectively create a universal banking system. Imagine something like UPI International instantly onboarding the 1.7 billion unbanked people globally, allowing them to save, transact, get credit, participate fully in the digital economy.
And the other huge piece is land, that massive amount of undocumented property. How does tech solve the problem of proving ownership?
This is where it gets really powerful. It's estimated something like 70% of land in developing countries is held informally, worthless as collateral. The tech solution involves combining satellite imagery and AI to precisely map and verify land plots, linking that data to the owner's digital identity, like Aadhaar, and recording it all in a blockchain registry.
Making the ownership record tamper-proof and transparent.
Exactly. Suddenly, that land title isn't just a piece of paper vulnerable to corruption or loss. It's a secure digital asset, and the impact for the owner is transformative.
How so?
It turns that land from dead capital into bankable capital. With clear, verifiable ownership recorded on a blockchain, financial institutions, even automated DeFi protocols, can instantly assess collateral value and issue frictionless microloans. This could unleash trillions in credit to smallholder farmers, urban dwellers, local entrepreneurs who were previously locked out of the system. It fuels grassroots growth.
A bottom-up economic revolution powered by code. Finally, let's touch on the convergence of blockchain with another transformative technology, artificial intelligence, AI. Sources see this combination as perhaps the ultimate democratizing force.
Yeah, the synergy is potentially immense. If you think about it, crypto helps democratize money and trust through programmable, transparent systems. AI helps democratize intelligence and knowledge by making sophisticated analysis and learning accessible to everyone.
How does that play out in areas like education?
Well, traditionally, high-quality education has been scarce and expensive. AI tutors, powered by advanced language models, can offer personalized, adaptive learning experiences at near zero marginal cost. They could potentially deliver world-class instruction to anyone with a smartphone anywhere on Earth. It could be the most powerful equalizer in human history, dramatically boosting global human capital.
And a similar potential exists in healthcare.
Absolutely. AI-powered diagnostic tools, AI assistance for medical professionals, AI driving drug discovery, combined with data from wearables and sensors. It could transform healthcare from a reactive, expensive system, often limited by physical access, into something much more predictive, preventative, and universally accessible. A public utility model for health.
So where does crypto fit into this AI-driven future for things like health and education?
Crypto provides the rails for value exchange and trust within these new systems. Think about paying for AI suitor services with micropayments, or securely managing personal health data ownership on a blockchain. More broadly, AI can analyze vast amounts of alternative data like mobile phone usage or utility payments to assess creditworthiness for people without traditional financial histories, enabling financial inclusion. Crypto then provides the secure, low-cost payment and settlement layer for these newly included individuals to participate in the economy. It's a loop. AI enables access and understanding. Crypto enables participation and value transfer. Money learns and learning earns.
So the vision is an economy measured less by static wealth and more by human potential unlocked and the velocity of value creation.
Exactly. It's about enabling distributed creation, empowering billions more people to contribute their skills, ideas, and assets directly and instantly to the global economy. That's a fundamentally different kind of economic model than the one we've had for the last century.
Okay, this has been a truly expansive deep dive. We started with a single piece of U.S. legislation, the Genius Act, S.394. And we've seen it's far more than just stablecoin rules.
Definitely. It's simultaneously a pragmatic reform aiming to make digital dollars safer and integrate crypto into the regulated system, and a deeply strategic move by the U.S.
A move to leverage the private sector to help manage its national debt and to reinforce the dollar's dominance in the emerging digital financial landscape.
That tension between safety and strategy, between domestic regulation and global power projection, that's really the heart of it. In the short term, you'd have to say the U.S. has skillfully positioned itself as the architect of the code. They've set the standards, ensuring a huge chunk of digital value will flow through regulated dollar-linked networks.
Which boosts confidence, supports innovation within their framework, and strengthens the dollar for now.
For now. But the long-term gamble is that reliance we talked about, the dependence on continuous foreign demand for digital dollars to finance U.S. debt, that creates vulnerabilities.
And it fuels that geopolitical backlash, potentially accelerating the BRICS and others in their quest for genuine alternatives for monetary sovereignty outside the dollar system.
That's the risk Washington is running. It sharpens the contradictions. And it brings us back to a fundamental question, maybe the oldest question in money, but updated for the digital age.
Who really holds the power?
Is it the issuer, Washington, setting the rules for the network? Or is it the believer, the billions of global users, who ultimately choose whether or not to adopt and transact within that system? What does financial freedom even mean when money can flow like water across borders and knowledge can flow like light via AI, all secured by lines of code rather than just by state authority? That's the big question this leaves us with.